even though you're in the Silicon Valley. Well, great. So we're glad you came. This is Avidbank. Um, the stock symbol AVBH for all you home gamers. The Julianne has prepared a fact sheet that's available on the website for our participants to look at as the presentation goes on. Do you want to share a presentation, or we're just going to have a conversation?
I think, Pat, did we send the deck in?
Yes.
Yeah, we have your deck.
Yeah. We're just going to use the deck to follow along for a few pages to kind of set the stage. I know there's probably a lot more questions than we're going to cover just in the presentation. So we're really curious to hear what's on people's minds. So we'll just touch on a few of the pages here.
Sure. Would you like me to man the slides, or?
Yes. Okay. I didn't know we had to share it. So yes, if you could share, that'd be great.
I got it. Okay, 1 second.
So we'll first, the audience, please use the Q&A box and send your questions in as we go along. Just as an introduction, I think Avidbank probably this year checked every box you could check about, what is going on in banking for this year. And with all those challenges, I have to say, if you look at the stock price, incredible stability, which I think is very much testament to your stewardship. So Avidbank is based in the Bay Area, and they operate in 3 local verticals: commercial real estate, corporate banking, and construction lending. And they have 2 national businesses, which focus on specialty finance and venture lending. So during the spring, when Silicon Valley Bank, was blowing up, Avidbank became part of the whole conversation in the turmoil. They shared with us their thoughts at our spring California conference, and we're really interested to see how you've come out of the mess, if the mess is still there. We don't hear too much about venture lending. It's kind of left the front page. So we're really interested in getting an update. So with us, we have Mark Mordell, who's the CEO, and Pat Oates, who's the CFO. And why don't we turn it over? You start and we can begin the conversation.
Great. Well, thanks for having us. Thanks for everybody for showing up. It has been a tumultuous year, would be an understatement, certainly. And especially with us being in the venture space as well as in the zip codes, the 2 of the biggest failures, brand name failures that we've had with First Republic and Silicon Valley Bank. So it's been a crazy year for sure, but I think we're gaining on it and starting to stabilize, certainly more so that since the beginning of this year. As Julian has said, or Ian has said, we're a $2.2 billion bank. We're based here in the Bay Area, headquarters in San Jose. We have a couple of production offices. If you turn to page 4, one in San Francisco and one in Redwood City. We're still in this hybrid environment, and will be for a while, where we have people coming in mandatory 3 days a week and 2 days a week, being more flexible. And as again, which was covered on page 5, we have our traditional real estate and C&I banking based here in the Bay Area. Our construction lending division does primarily single family spec homes in the Bay Area here. And we've been in that space since 2008, if I'm not mistaken, or 7. And it's been just a solid earner for us. We don't try to grow the portfolio very large. It's just that we have repeat borrowers, a very lean staff that knows what they're doing. And it's been incredibly, probably our most profitable vertical that we have in terms of margin. Corporate banking is traditional C&I. That's based here in the Bay Area. And then our commercial real estate, almost all of it is here in the Bay Area. Pat will go through some of the metrics on the breakout as we get more towards the financials. Again, as was indicated, a growing national presence with specialty finance and venture lending. We're pretty much geographic agnostic on that. Venture lending, we're doing early to later stage investments, loans, and which is primarily a deposit play for us. Specialty finance is everything that venture and traditional C&I lending isn't. So we have monthly recurring revenue lines, asset-based lending, invoice financing, sponsor finance, private equity finance. And we, again, are geographic agnostic to that. If you turn to the next page, you can see on number 6, kind of a breakout of the lending and clientele that we have across the country, as well as where we have people located. So obviously here in the Bay Area, Arizona, Southern California, Colorado, Texas, Connecticut, Raleigh, and Boston as well. So we have people that are scattered across the country in terms of generating business. And this gives us a nice, for a $2 billion bank, gives us a nice level of diversification from where our business is coming from. So that's the general outline of who we are and what we do. And Pat, you just want to touch on the quarter results?
Sure. So, third quarter, as you talked about, it's been an interesting year, but third quarter, we saw some nice stabilization, some nice growth from the bank. Loans were up about $20 million, 5% annualized. We're focused on average deposits here because we're a commercial bank and deposit balances move around quite a bit. So it's a better way to look at the growth that we're seeing. So we saw nice growth average-wise, 53 million or 30% annualized. And then profitability's, stabilized here, hopefully improved from here. ROA about 99 basis points. We like to highlight here our uninsured deposits are now about 35% of our deposits. That's from probably the mid-80s that we had, beginning of the year, based on our concentration of commercial business, using reciprocal deposits and some other things. And then credit qualities are really strong for us, with no charge-offs and good NPAs. And then just some quick highlights on the deposit portfolio. If you look at the top left, we have about 25-30% non-interest-bearing deposits. That has come down, obviously, with everything that's happened this year, but it's still a healthy portion of our deposits. Bottom left there, you can see how diversified our deposit portfolio is based on our lines of business. And then, like everybody else, we're seeing an increase in cost of deposits, particularly for us, probably more now business than a traditional bank because of the commercial focus, and our customers are probably a little more rate sensitive. But what we're hoping is we're at the end of seeing the large increases that we've seen. And then quickly, the loan portfolio. If you look at the bottom left there, you can see it's pretty diversified across our different loan types. Just to highlight the commercial real estate piece there, since everybody's kind of focused on that. We have about 143 million office loans, about 9% of our portfolio. And the average size of the loan there is, less than $3 million. Okay. And obviously, we have a pretty big floating rate loan portfolio book also. Okay. And with that, Mark, back to you. Anything else?
So if we can, as far as the formal portion of the presentation goes, I'm sure that's really it in terms of giving the overview. I know with the kind of investors that are on this call that you all probably have some questions for us. So Julian or Ian, do you want to set the table and probably stop sharing the screen so we can see who's on the line? And there we go. And
so why don't we start where we left off the last time, the state of venture banking, and included with that, I think you were starting to see, what has happened with the big 800-pound gorilla, Silicon Valley Bank, kind of out of existence. Is this opening opportunities for you? Are you getting business? So why don't we start from there? And I also wanted to introduce everyone. Gina Patterson, Chief Operating Officer. I see she's joined the table. Welcome. Thanks.
Thank you.
The venture lending vertical has, for the first time in 20 years, experienced some softness. It started to experience softness mid-year last year, essentially. And so, after a 20-year run of up and to the right, there needed to be a correction that's been overdue for a period of time. So, so I think, you know, certainly this year has been a specific challenge for venture lending, and we're starting to see it thaw at this point. We're starting to see companies get funded on their, you know, B or C rounds. We see new companies getting funded in their A rounds, and we see new funds actually being formed in 2023, ready to pounce in 2024. Is it back to where it needs to be? The answer is no. I think the venture lending space is going to be changed. I don't want to say, yeah, forever compared to what it was 24 months ago, primarily for the removal of the 800-pound gorilla. You know, Silicon Valley Bank could move the market virtually any time it wanted to, and that's been proven time and time again when we've been in the direct space for the last 4 or 5 years now. Those bankers from Signature, FRB, and Silicon Valley Bank have permeated it into maybe 6 or 8 other institutions over the last 10 months or so. I think removing the 800-pound gorilla is going to have more parity to the other venture lenders that are going to be in the space, because there's not just one big gorilla that's out there controlling or moving the market. Those bankers have landed all over the place. I think how First Citizens and customers are going to react down the road, how committed they are to that space is going to remain to be seen, just like any acquisition that we've seen of venture lenders. We saw Bridge Bank get acquired by Western Alliance, and it took them 3 years to figure out what their sweet spot was. You had PacWest acquire Square One, yet another 3 years to kind of figure out, you know, where do we fit? What does it look like? How do we treat those? How do we treat those credits? Because it is more of an art and a relationship than it is a science, unlike other lending. So, you know, we'd like to think we've seen the worst of it, because again, is venture lending flawed? I don't think venture lending's flawed. I think what's flawed, and it's killed us in this year in our industry, is really poor balance sheet management. And I think that's the awakening when you get a little complacent of being up and to the right, flush with deposits, not only in the industry, but what the government has been generating, you know, really since the beginning of COVID as well. There were a lot of very cheap, no-cost deposits associated with that, and had such imbalanced loan to deposit ratios that trying to put that money to work in a zero interest rate environment, given the rate hikes that started last year, you know, it's you know, there's no math that says there's not going to be some sort of pain that's there. So I think the space is going through its correction, and it's going through its correction in a time where there's a lot of new people calling the shots with the same lenders that are actually out there doing the business. So I think it's still it's a viable vertical. You know, we're not as angular as other banks that are out there for a bank our size, and so having the 5 verticals as opposed to being so heavily dependent just on venture is a good place for us to be, and that was by design. So cautiously optimistic for 24 versus 23, but it's going to take a little bit of time for this to settle down. But I don't think technology really rests all that long. Those companies that are doing well, that are out there in a space and gaining market share, they need to get funded, and there's plenty of capital that's out there to fund the quality companies.
Great. Let me get to some of the questions that are coming in. Looks like there's some very, very informed audience here. So related to that, one of their questions is that they mentioned that you hired some bankers that were formerly with Signature, and when would you expect them to start producing deposits for you? Also, that they mentioned that there was a fairly large NPA in the past, and has that been resolved?
We'll take the NPA because that's a shorter answer. The NPA, it's been significantly resolved. We did, can we say that? Or not? It's been resolved. and you'll read about it, and it was
More details at the quarter end.
yes, it's a favorable outcome, as we hope. So the MPA's, it's been 90% resolved, and then we have to follow up on some other things. But yeah, it's a favorable outcome for us. So it's as we anticipated.
New lenders.
Yeah.
The new lenders. They are treasury management people, and they were known to many. All three of them are ex-Square One alumni, so they're known to Pat and to a lot of our people here. We had 3 people in treasury management. Art brought himself and 2 more, so now that's 6 people in treasury management. And with that, they're going to be accretive. They're already paying for themselves this year because of the foundation that we've already established. So with just the business that we have, he was able to renegotiate a bunch of contracts, bring things to market, and that alone is going to be in excess of 6 figures of fee income a month just from tweaking what we a quarter, excuse me, just from tweaking what we have at this point. So as we look into the future and having these treasury management people work with our lenders, we expect that they're going to certainly start to pay them for themselves into next year. And addressing one of the areas that we have been weakest at since we've been in existence is our non-interest income and fee income. So he was billed as a plug and play type of person, and I think he's been that and more. He understands the ecosystem, he understands the market. He's been educating our bankers. He and his team are now we're just looking like a much more complete institution when we're going out there with clients, having our lender and treasury management together, so we get the front end of this opportunity to really bank the entire company and make money at the services we're providing besides just on the debt side.
Great. There's a couple questions about, I think, your net interest margin going forward. How do you see that with somewhat of a decline in non-interest bearing deposits and some maturity? I'm combining these questions, and some upcoming maturities in wholesale funding. How do you think your net interest margin is going to be tracking or would be tracking in 2024?
Yeah, so the pressure on the margin in the last several quarters has obviously been the increase in deposit costs and the decrease in DDA, right? After everything happened in March, the focus here was retain every deposit we can, right? And try to bring in any depositors that we can, right? So we were not as concentrated on rate or that DDA. Now that things have stabilized, we're shifting that, and our new treasury management team is helping with this, right? Now the focus is on let's make sure we're pricing these customers properly, and let's hold on to whatever DDA we can hold on to, right? So, what it feels like as we went through the third quarter is deposit costs are really starting to stabilize, right? It's not that it's not going to go up still, right? But our existing clients are not calling as much, wanting higher rates. We got a pretty good handle on new business. The biggest pressure on deposit costs is probably bringing in new business, because other banks are paying high rates too. But we think we've got our hand around that. We shouldn't see the same level of increase around the deposit costs. And hopefully we've seen a floor on DDA and start seeing some stabilization there also. And then on the loan side, that loan yield is going to continue to move up, right? The new business we're putting on is, over 8% handle, right? So that's going to help the 7% loan yield, right? Then we also have lower yielding commercial real estate that'll start to mature over the next, several quarters. So that should help the loan yield move up. So that makes me think that hopefully we've seen a floor here in the margin, and you might see start seeing some expansion also.
Oh, terrific. Yes, thanks. An interesting question, one that I've looked at with several banking institutions. Have you run any analysis about realizing some losses on securities and allowing you then to redeploy it either through lowering your borrowings or replacing it at higher yielding. How would, and of course you have constraints about capital, when can you do that with your capital, but interesting to hear your thought process about that.
So we did it in March, right? When after all the stuff with Silicon Valley happened, we sold, what was it, 35 million or so in securities at a small loss, including all of our hold maturity securities, since that was a concern for investors. So we did do that initially, right? To do any more, the capital impact would be real, right, on regulatory capital ratios. So we've looked at it quite a bit. And we're continuing to evaluate alternative strategies around what we could do. So we'll see, but it's difficult at this point with the size of the losses.
Yeah,
And luckily, this portfolio is smaller now as a percent of our balance sheet than it was last year.
yeah, it's obviously it's been an issue for us. When the debacle went down in March, we had to report to our regulators on a daily basis about liquidity. And that's actually, then it fell off to a weekly basis, and now it's zero. But one of the things that has been pretty amazing during this time is how supportive both of our regulators have really been, because of the fact that we really look at everything on our balance sheet, kind of wipe the slate clean, and seeing, what do we need to do in order to get the maximize out of it, maximize our the efficiency of our balance sheet, given what we can't do. And so I think they've been pretty pleased, as has the board as well, that we're doing and pulling the levers all that we can to kind of get to the other side of this thing. And so they've been very, very supportive, and because we are looking at virtually everything, nothing's off the table, for us to kind of improve that margin going forward, because the whole world has changed in the last 10 months for sure.
Thank you. So here, very interesting question, given the emphasis on indexing today and the power of indexes or indices. You have a question here that you are on the Russell 2000 edition threshold, but you're listed on the OTC, so you're not eligible for Russell. Have you thought about becoming an SEC registrant and listing on NASDAQ?
Yes. That's always part of the narrative. It's receptivity, it's liquidity and size and float and all those things. So the Russell is important to us because it is a metric that people are investors are interested in, clearly, and we realize that. From where I sit, it's always a priority, but second, it's a backseat from what we need to do in the near term right now in terms of improving our margin, our profitability, and everything of that nature. And if we can do our job the way we intend to and have in the past, I don't want to be doing chin-ups over the entry of the Russell to be knocked out the next year, for example. So I think we're going to continue to improve all our metrics, scale our operation, and let the cards kind of fall where they may. And if we're solidly into the Russell, Russell 2000, the Russell, then is that going to drive the bus about accessing the public markets? Probably not. We have to see how receptive the public markets are to a bank like us, and really what has happened to size and scale, today and going forward than what it was 12 to 24 months ago.
Right, great. So question on your footprint, that you're doing business on the East Coast, Texas, etc. Has that posed any challenges, or doing business in these different regional economies cause you to do different things or look at things differently?
Well, I think the reason we're geographic agnostic on those two verticals, venture and specialty, is because they're typically more transaction oriented in a space than it is in a full-blown operating company. So so it hasn't presented any more challenges than local investing. I think all the decisions, all credit decisions, all disbursement decisions are all done here out of San Jose, not at a local. We don't have a local office over there that's kind of running with the Raleigh or the Austin economy. So we take that all into account. The front end, we have portfolio reviews virtually every month for every division. So we go through all the questionable credits or things that may be strained, classified, certainly criticized. So we're not seeing any trends whatsoever that Southern California is better than Northern California or vice versa. So we're pretty comfortable outside the state, given the types of products that we have out there.
Okay, let's turn to the home market and commercial real estate, office, San Francisco, San Jose, all these issues that we hear about. How is it looking? How are real estate values holding up? Are developers still working? Talk to us about about the lending and real estate environment.
Well, let's go with the easy one first. The housing market has remained relatively robust given everything that's going on. It's certainly like everything else in real estate, it's location focused, and parts of San Francisco are really taking it on the chin. But the amount of inventory that's been on the peninsula is just not that great. People aren't selling their homes to take on a 7% loan versus a 3% loan. So inventory has been down, therefore prices have been pretty stable or increasing. So which is really quite a surprise. As far as our portfolio goes, we only have we have 20 homes on the market at any one time. They're all new construction and they all seem to be selling, right there in the ballpark and above the appraised value and market value. So right now the residential market is reasonably stable, with the exception of parts of San Francisco. I think apartment markets, therefore, because inventory has been low, multifamily has been pretty stable as well in the market. So, we do DCR tests all the time, vacancy tests, all the rent reporting. We don't see a softening in the multifamily, especially the stuff that we're in, which are smaller units, typically 30 units and under. Industrial, warehouse, really hard to do, manufacture things, from home. So that seems to be solid. Office space is the question. We're not terribly exposed to 100% office space. Urban is going to be much rougher than suburban. We see more things happening, more velocity in the suburban office market than we certainly do in the urban markets. I mean, anywhere there's a commute right now is going to be a bit challenged when you've changed people's patterns of how they operate. That if they don't have to drive an hour each way and they can work from home, do they really want to come in a few days a week? So how are employers going to make longer term real estate decisions in today's environment when it's going to take a while to settle down what hybrid work or flexible work really is? And it's going to take a while for that shine to come back to San Francisco, that's for certain. There's been properties that have gone back from very, very legit developers because there is no math for them to hang on to the building. And that's why you've read about these things going back at 30 cents on the dollar. I mean, how do you underwrite vacant space in today's market? Do you put 5-year window on it, or more? So people are buying these things for a song because the existing owner there's just no math that gets them there at the end of the day. So it's going to be a bit of a challenge because normally in a recessionary time in real estate, that the the tenants that are in the C buildings go to the B buildings, and the tenants in the B buildings go to the A buildings, and the tenants in the A buildings just get a better deal in the A buildings. But no one's making long-term decisions right now because they don't need to. Most landlords will allow them to sign up just for a year so they can get a little more clarity on what their needs are going forward. So it's going to be tough in the commercial market, certainly in San Francisco, in the office space market. And, you know, it'll be more stable in suburban downtown locations, in, you know, Palo Alto, Burlingame, Los Gatos, those stuff is a little more boutique-y, a little more stabilized. And there's still a demand for that, as we're seeing. So, you know, but I personally don't see any math that there's not some serious losses being taken from an industry standpoint on the commercial real estate arena. You know, when you look at these major urban markets, that there's a significant amount of debt in those markets.
What about, I'm just curious about the AI revolution and San Jose, you know, is there any noticeable impact on commercial real estate in that area because of AI?
No, I think where you see the AI metric really kick up is in the venture and the venture lending spending or investment on that on AI. I think the industry itself is no different than any other industry. I think a lot of these folks are hybrid and remote, and you know, since the employee pendulum is kind of stuck on the employee side for the length of time that it has, still the competition for talent still is pretty great around here. So I haven't heard or haven't seen a significant impact on the commercial real estate space as due to that vertical. But you know, a lot of those CEOs will tell you as well, if they really are going to scale a company, maybe the Bay Area isn't the best place to do that because of the tremendous costs that are associated with this here, where the think tank will be here, but maybe they scale the company in either a more lifestyle, more business friendly portion of the country or the state, probably the country given California. So I think that's going to remain to be seen of how that actually impacts the commercial market. I don't think it's going to be a significant impact on it, just given the dynamic of the way those companies run right now, at least what we're seeing.
Okay. And just one last quick question about your stock ownership. You know, you had sold stock in a private placement a couple years ago, 2022, actually, not that long ago. And so because you're not a filer, you know, you don't have to file the ownership reports, but several of your investors have self-reported, which is what's on our at a glance sheet. It's an impressive shareholder list, and you have quite a sponsorship. I was just curious if there was anyone else, you know, on who's an owner that just doesn't show up, or you can talk to that at all.
There is, but most of them don't like to have that disclosed, or you know, just because. You know, we've been fortunate over the last 10 years to have a really supportive investor base that have answered the bell a number of times, and we had new people that have been added. You know, we have you know, a large investor that's over 10%, and then we have, you know, several that are between, you know, 4.9 and 9.9, and they've been pretty stable and pretty supportive. I mean, we talk to them regularly, and you know, they're not afraid certainly to challenge us on several levels, but they've known how we've operated and they've been really supportive. And you know, we're just going to keep marching forward to find out what the best you know, what the best avenues are for having more liquidity down the road.
Okay, it's been a positive. Okay.
Yeah.
All right.
Well, thanks so much to all of you to taking the time to come talk with us. We really appreciate it.
Absolutely.
We appreciate being invited, and look forward to seeing you again.
Thank you.
Thank you.